September 2008. Lehman Brothers collapsed on a Monday morning. By Friday, $10 trillion had vanished from the global economy. Pension funds plummeted. The mortgage market froze. Banks stopped trusting each other overnight. But on a Manhattan trading floor, John Paulson was looking at a $15 billion profit. He wasn't a victim of the crisis. He was its architect. The instruments he used weren't shown on TV. They weren't discussed on the news. Most retail investors didn't even know they existed. The advice is always the same. When the economy crashes, save your capital. Move to cash. Move to gold. Wait out the storm. This logic is why ordinary people lose every single time. First, they lose in the initial crash. Then they lose again. They try to re-enter the market during the recovery, but it's already too late. Crises do not destroy wealth. They redistribute it, and they do so through the same 5 assets. Over and over again. In 2020, one of these assets returned 57% in just 6 weeks. Not a single mainstream financial advisor mentioned it. Not one. Asset 1. Long-term bonds. The average person treats bonds like a trip to the dentist. They understand it's probably good for them, but they don't want to deal with the details. This is a dangerous misunderstanding, because in a moment of true economic shock, long-term government bonds are not a boring instrument. They are a capital growth machine. The mechanics are precise. As soon as the economy begins to fracture, central banks panic. They cut rates fast and hard. In 2008, the Fed slashed the rate from 5.25% to near zero in 14 months. In March 2020, they cut 150 basis points over a single emergency weekend. When rates fall, old bonds with higher coupons become more expensive. Not slightly, significantly. Imagine a 20-year Treasury bond yielding 4% when new issues are yielding only 1%. That old bond becomes a scarce asset. It pays more than anything else on the market, and its price rises with brutal mathematical inevitability. In 2008, while the S&P 500 dropped 38%, the ETF for long-term U.S. Treasuries (TLT) rose by 33.8%. It didn't just hold its ground, it surged. At the very height of the crisis, while most people were staring at red portfolios, bonds were deep in the green. If you look back to the Great Depression, the pattern holds. From 1929 to 1932, stocks lost 89% of their value, while long-term U.S. government bonds posted positive returns every single year. For 4 years, the economy was disintegrating, yet bonds went up. Because in a real crisis, the primary fear isn't inflation, it's deflation. When credit contracts, prices begin to fall. When prices fall, fixed income becomes more valuable because future payments buy more real goods. Money flees risk and pours into sovereign debt. This is why long bond prices can rise at a speed that seems illogical to those who only watch stocks. The 2020 COVID crash showed this with clinical clarity. While the stock market went into a tailspin, TLT gained about 25% in less than 6 weeks before the bottom. If an investor understood this link, they didn't just have a hedge, they had an asset that generated profit exactly when every other asset was bleeding out. Why isn't the public told this? Because the financial media is obsessed with stocks and bonds are considered boring, right up until they are the only green line in the portfolio. By then, it's too late. Asset 2. Volatility. This is territory most people have never even considered. Volatility is not just an abstract fear gauge, it is a full-fledged asset class. And in a crisis, it can explode harder than almost anything else. Take the VIX, the index of expected volatility for S&P 500 options. Simply put, it measures the amount of fear baked into the market. When things are calm, it usually sits around 12-15. When nervousness begins, it creeps up. But when a real collapse starts, it doesn't just grow, it detonates. In February 2020, the VIX was at approximately 14. Markets were still in euphoria, stocks were at all-time highs, and most people had no clue what was coming. By March 18, 2020, the VIX hit 85.47. That is a growth of over 500% in 6 weeks. In October 2008, the index reached 89.53, rising from around 20 at the start of the year. This isn't normal price movement. This is market panic in its purest form. And yes, you can own volatility as an asset. Since 2009, there have been exchange-traded products tied to short-term VIX futures like VXX or UVXY, which provides leveraged exposure. When the market storms, these instruments can behave in ways that seem impossible to the uninitiated. During the COVID crash, their charts looked like they were drawn by hand. The movements were that vertical. Why aren't these sold to every retail investor? Because they have a dark side. During quiet periods, they slowly and painfully lose value due to the structure of the futures market, known as contango. Essentially, if you hold them too long, they eat your capital. That's why financial advisors hate recommending them to the masses. Too many complaints, too much misunderstanding, and too much theta decay when the market is calm. Institutional players see it differently. Any serious portfolio manager holds some form of volatility protection. John Paulson in 2008 essentially bet on an explosion of volatility in mortgage lending by buying credit default swaps when the market didn't believe defaults were possible. When the market tore apart, those contracts turned into massive wealth. The conclusion is simple. Volatility is not just an indicator, it is an asset, and it performs best when the market is most terrified and least capable of understanding its own condition. Asset 3. Distressed debt. This is rarely discussed at the dinner table or on social media, but distressed debt is one of the most consistent wealth creation machines during crises. The essence is this: during a panic, sellers do not value assets rationally. They sell out of necessity. Banks are trying to plug holes in their balance sheets. Hedge funds are facing redemptions. Insurance companies are following regulatory constraints. They don't care what the paper is actually worth. They just need to survive today. Consequently, they might sell an asset with a real value of 90 cents for 30 cents just to avoid a total collapse. This is how distress works. Panic creates a price that is completely disconnected from fundamental recovery value. In March 2020, this mechanism was on full display. Investment-grade corporate bonds were being sold as if the world had stopped functioning. LQD, the ETF tracking investment-grade corporate debt, dropped nearly 20% in 3 weeks. For AA and AAA rated papers, this was completely unnatural. It wasn't rationality, it was forced liquidation. Then the market rebounded. From the March bottom to December 2020, LQD recovered by about 25%. High-yield bonds showed an even sharper recovery. HYG lost about 24% in the crash, then returned to new highs within 7 months, gaining roughly 40% from trough to peak. But the real money isn't in ETFs. The real money is in buying debt instruments directly at panic prices. After the 2008 crisis, institutional investors were buying mortgage-backed securities for 20 to 40 cents on the dollar. There was risk, yes, but even accounting for defaults, the real recovery value was significantly higher than the purchase price. That's why early buyers made 3 to 5 times their invested capital. Howard Marks of Oaktree wrote to his clients in the fall of 2008 that it was one of the most attractive opportunities of his career. His funds during that period saw spectacular results in the following years. The same happened after the Latin American debt crisis, the Asian financial crisis, and the Argentine default. Every time, those who bought someone else's fear were later paid a massive premium for their patience. The signal is recognizable. When high-yield spreads blow out to 800, 1,000, or 1,200 basis points over treasuries, the market is effectively saying the economy is heading for the apocalypse. But in a world with functioning central banks and a legal system that almost never reflects the full picture, people sell not because the assets are worthless, but because they have no time to wait. That is where the window for capital lies. Asset 4. Gold. Everyone seems to understand gold, or they think they do. When things get scary, buy gold. When everything collapses, gold will save you. This is a popular, beautiful, and dangerously incomplete narrative. In reality, gold often falls during the first phase of a crisis. In 2008, it reached about $1,000 per ounce in February, but by October it had plummeted to $720. Amidst the worst financial crisis in decades, gold lost nearly 28%. If someone bought it early as catastrophe insurance and sold in a panic in October, they didn't protect their capital, they impaired it. Gold's true function is revealed not during the shock itself, but in the response to the shock. When central banks start printing money, slashing rates, expanding balance sheets, and artificially propping up demand, gold begins to do what it was born to do. It becomes the antithesis of a diluted currency. From the October 2008 bottom, gold rose to approximately $1,900 by September 2011. That is a 164% increase, not before the crisis, but after the panic had shaken out the weak hands. That was when gold showed its true strength. The mechanism is direct. In 2008, the Fed's balance sheet grew from about $900 billion to $4.5 trillion over a few years. In 2020, the move was even more violent, from $4 trillion to $9 trillion in 8 months. When the money supply grows at that pace, every existing unit of currency becomes a smaller slice of the real asset pie. You cannot print gold. You cannot create it by decree. You cannot scale it like a central bank balance sheet. There is an older story rarely mentioned. In 1933, FDR signed an executive order forcing private citizens to surrender their gold to the government, then fix the official price higher. This was a form of controlled dollar devaluation against gold. Those who held gold outside U.S. jurisdiction won almost instantly. Once again, the state itself created the mechanism that made gold one of the best assets of the next decade. That's why gold should be understood not as a hedge before the crisis, but as a bet on the government's reaction after the crisis. When real rates go negative, when the printing press is running at its limit, and when political pressure on monetary authorities becomes unbearable, gold finds its window. And that window almost always opens not at the peak of fear, but when most people have decided that gold doesn't work. Asset 5. Farmland. Finally, the quietest asset of them all, the most boring in appearance, and in many ways, the most fundamental. From 2007 to 2012, median home prices in the US fell by about 26%. Commercial real estate in key markets dropped 30–40%. Stocks were literally cut in half. The financial press called it the greatest destruction of wealth since the Great Depression. Yet, over that same period, American farmland rose by an average of about 30%. This is no accident. It reflects the fact that farmland is not just real estate, it is a productive asset. A field of soybeans or corn doesn't care what happened to Lehman Brothers. It continues to produce a crop, and crops are food. And people need food regardless of whether the bond market is alive or dead. In Iowa, according to USDA data, the average price of farmland in 2007 was about $3,900 per acre. By 2012, it had risen to about $8,400 per acre. That is a 115% increase. All of this happened while the rest of the financial system was choking on the worst crisis in a century. Why does this happen? Because during financial ruptures, food becomes an even more sensitive topic. Supply chains break, price instability grows. It becomes clear that the demand for food is inelastic. You can delay buying a second apartment, but you cannot delay eating for a year. Therefore, any asset tied to food production gains an inherent resilience that paper instruments lack. If you look at the 1930s, the picture is similar. The Great Depression meant unemployment, breadlines, and mass fear. But farming families who owned their land debt-free experienced that era very differently. They had food security, local barter, real production, and land that retained value independent of Wall Street tickers. Farmland has another vital property. It is almost entirely orthogonal to the financial system. Long-term bonds depend on central banks. Volatility depends on derivatives. Distressed debt depends on courts and the legal system. Gold depends on global markets and monetary policy. Land depends on soil, water, and biological processes that have existed for billions of years. No government debt instrument can claim that. However, there is a limitation. Land cannot be moved. It cannot be sold quickly without liquidity haircuts, and it can be seized if a regime becomes harsh enough. Zimbabwe's history showed this clearly. A political decision can destroy property rights even if the land remains fertile. The value of the land doesn't vanish, but the owner might vanish from the equation. This is why the ownership structure matters as much as the asset itself. Land in a stable jurisdiction, without excessive debt, producing export crops and generating revenue in hard currency, is one of the most resilient forms of capital in existence. It doesn't have to jump 300% in a quarter. It can grow slowly for years, but it does so exactly when the rest of the world's capital is burning. Crises break paper structures, but people will always need to eat. Here is the ultimate conclusion that repeats in every major crisis without exception. Money doesn't disappear in a crash. It changes hands. It moves from the unprepared to those who took their positions in advance, from the reactive to the structural, from those who listen to headlines to those who understand the mechanics beneath them. Long-term bonds surge when the world fears deflation and central banks cut rates. Volatility explodes when fear becomes the market's most expensive currency. Distressed debt offers the best deals when sellers are no longer selling based on value, but for survival. Gold works not before the shock, but after, when states respond by printing money. Farmland follows its own path because food remains a necessity regardless of the stock exchange. The winners of 2008 weren't wizards. They simply understood the patterns ahead of time. Every collapse feels like the end of the world to those inside it. And every collapse looks predictable to those who have already prepared for the redistribution of capital. The difference between these two groups has never been intelligence. It has always been preparation. The question isn't whether there will be a next crisis. The only question is which side of the redistribution you will be on when it arrives.